I usually don't suggest to people they should be disruptive. But if you're starting a growth startup, a disruptive innovation strategy is your most likely path to success. By the end of this video, you'll understand what is a disruptive innovation and how that's different from a sustaining innovation. And we'll go through an example to try to make it that much clearer as to what exactly does disruptive innovation mean. And then we'll talk about the proof, the research that strongly suggests that a disruptive innovation strategy is your path to a higher likelihood of success. And then we'll try to pull it all together by talking about how you can apply all of what you've learned to create your own disruptive innovation strategy so you can increase your chance of startup success. So what is a disruptive innovation? A disruptive innovation is a process. It's a process that begins when there are customers that get left behind. Customers tend to get left behind when you have sustaining innovation. That's when you have multiple companies in a market that are competing head to head, and they each introduce new products with more features, more capability, more performance. The products get better and better so that they can get a little more market share and get more revenue. Perfectly natural thing to happen. But as that happens, the other thing that tends to come along with it is an increase in price. And because of that, more and more customers get left behind, which means there are customers that would love to have the capability. They'd probably even be okay with a little less capability, but they don't have access to it because it's just not in their price range. A disruptive innovation begins when another company realizes that there's that gap. There are customers that have been left behind, and they create a product that's actually less capable, usually smaller, usually not as attractive, but at a lower price. And a product that, although it's less capable, is good enough for at least a lot of the customers that got left behind, the customers who can't afford the other products that are on the market. If they could, they'd certainly prefer those, but they can't afford it. And if you offer a product that's good enough, even though it's not as fancy as the products that are available elsewhere, that creates a disruptive innovation. Once a company takes advantage of a disruptive innovation, they provide this lower capability product, they get a toehold in a market selling to these sort of low end of the market customers, and then over time they slowly improve their product, sustaining innovation. And as the product gets better and better, eventually it becomes acceptable to the mainstream customers. And if the company can do that while maintaining their cost advantage, that then is a key for taking over a market. And that's what happens in your classic disruptive innovation. So let's talk about an example, the U.S. auto market back in the 60s. Now, in the 60s, Ford, Chrysler, and GM owned the car market in the United States. They kept competing head to head, offering more features, better performance, more horsepower, and so forth, each trying to eke out a little more revenue and gain market share over the others. But in doing that, they left a lot of customers behind. There were customers who couldn't afford a Ford, Chrysler, or GM, and yet they wanted a car. They were forced to buy an unreliable used car or walk or take the bus. They didn't want that. They wanted a new, reliable car, but they simply couldn't afford it. Well, some companies in Japan, Toyota, Honda, and Nissan, recognized that opportunity and started providing cars that were a fit for those customers that got left behind. Now, they were smaller and cramped. I mean, definitely not as nice as the cars that were being made by the big three. They were less safe. I mean, they were smaller. They were less safe if you got into an accident. And they were definitely not cool. I mean, these were looked at way back then as sort of toy cars. They weren't real cars. Real cars were Ford, Chrysler, and GM. It was almost a little embarrassing to be seen in one of these cheap Japanese imports. But if that's what you could afford to get a reliable new car, well, it became a good enough solution. It was lower price, better mileage, which made it even lower price, really, to operate, and it was more reliable, so it even had lower repair costs. So all of those factors made it good enough for the people who couldn't afford a real car from Ford, Chrysler, and GM. What ended up happening? Well, of course, Toyota, Honda, and Nissan kept then introducing new cars with more features, more capabilities, more performance, and eventually their cars became acceptable to the mainstream market. And eventually, as you know, Toyota became the #1 car company in the world. So that's a simple example of how a disruptive innovation can be an effective way for a new entrant to enter a market where there are very well established dominant competitors already in the market, by going after those customers that have been left behind and then eventually take over that market. That's the potential of a disruptive innovation. So let's talk about the research that's behind a disruptive innovation. And that research was done by Thomas Thurston. Now, Thomas used to work for Intel Capital, which is one of the biggest venture capital companies in the world. So they had a pretty large portfolio to take a look at. What Thomas noticed, though, was that the vast majority of companies that Intel invested in were not successful. And he had to wonder, isn't there a better way to pick your investments to increase your odds of success? What he did was he took a look at a portfolio of 48 companies, and he decided to test 4 hypotheses. Hypothesis 1 was that if the company was applying a sustaining innovation to get into an existing market, a market it was already in, it was already competing in, and that meant by sustaining that they were doing a better product, right? A product that was better, that had better features, performance, some edge on the existing competition in that market segment. If they did that, then his hypothesis was that their odds of success were pretty good because that's a classic sustaining innovation kind of opportunity. On the other hand, if he looked at doing a sustaining innovation, offering a better product, again, more features, more capabilities, more performance, and going into a market that was a new market for that company, his prediction was that's likely to not work. Now, why would that be? Well, you can think of a couple of reasons. You're offering a better product in a market that's a new market for you that has entrenched competitors. Those competitors look at you and say, this company is going after our best customers, and they'll do everything they can to try to make sure that you don't succeed. So you immediately get a response from the entrenched competition when you're going after their best customers. So it kind of makes intuitive sense. On the other hand, looking at a disruptive innovation where you're going after the underserved, the customers that have been left behind, if it's an existing market opportunity where a company, again, is, let's say, entering a market they're already in, but now they're saying, oh, hey, we're not getting to everybody in this market. Let's go after those customers that have been passed up. Well, his prediction was that that was a recipe for a disaster. Again, one reason, well, think about it. If you have a product line in an existing market that's higher margin, that's going after the mainstream customers who will pay more, if you invest in a lower end product for customers who can pay less, it's going to be less revenue and lower margin. That's not very attractive. It's very easy to get into that discussion that says, hey, why are we spending money on this low-end product? Look at how much money we're making on our mainstream products. If we took the money we're wasting on these low-end, cheap, low-margin products and invested them in our high-margin businesses, we'd make a lot more money. And that's what tends to happen in a situation where you try to do a disruptive innovation. So again, his prediction was no success. The final hypothesis was if you do a disruptive innovation when you're tackling a new market, a market you're not addressing already, then the odds of success there are much higher. Again, intuitively, kind of makes sense. You're doing a disruptive innovation, much like the Japanese car companies did in the US auto market, by going after those customers that were left behind that can't pay as much as mainstream customers, and the entrenched competition tends to ignore you because, after all, you're going after customers that they're really not that motivated to go after. Those were his hypotheses, and the question was, based on those hypotheses, could he predict the winners and the losers in the Intel portfolio? Well, he went through that portfolio of 48 companies, and he categorized each one into one of these four categories. Were they sustaining existing, sustaining new, disruptive existing, or disruptive new? And based on what category they were in, and based on no other data, he predicted whether or not they'd be successful. Let's take a look at the results. The results actually were pretty impressive. There were 48 companies. Now, what happened in reality was out of 48 companies, there were just 5 successes. In this situation, he defined success as a company that survived. Pretty basic success measure. So out of those 48 companies, 5 of them survived, which meant there were 43 that failed. Now, that does say something about the odds of success in startup businesses, at least in the businesses that Intel Capital was investing in. What did he predict? Well, he predicted that there would be 6 successes and 42 failures. So he wasn't 100% spot on, but out of those 6 successes he predicted, he correctly identified 4 of the 5 winners. Now, that means he identified a couple of companies he thought would be winners that weren't winners, and one of the companies that he identified as a loser ended up being a winner. So his prediction wasn't perfect, but it was pretty darn good. In fact, statistically, the odds of him getting something that was that close to being correct, 1 in 2,500. So those are pretty impressive odds, based solely on knowing whether or not they were disruptive or sustaining, and whether they were entering a new market opportunity or an existing market. He was able to predict success with that kind of accuracy. And that's pretty compelling evidence that if you are a startup entering a new market opportunity, which by definition is what you're doing if you're an early stage startup, a disruptive innovation is a pretty good strategy to follow. So how can you take these lessons to heart and figure out how you can disrupt a market? Well, it all starts with identifying a segment of customers that have been left behind. Customers who want some capability. Other people, mainstream customers, are getting that capability, but there's a segment of customers that aren't getting that capability because they simply can't afford it. If you can figure out how to provide a solution that's acceptable to those customers that have been left behind, something that's good enough for them, that probably doesn't have all of the features, right? But even though it's less capable, it's also at a price, at a cost that they can afford. That is the opportunity for a disruptive innovation. Even though you're offering something that's not acceptable to the mainstream market, that's okay. That means the entrenched competition is probably going to leave you alone because you're not going after their best customers. And that, in a nutshell, is how to put together a disruptive innovation strategy. It's not that complicated. Start with customers that have been left behind, identify a solution that's acceptable to them that you can deliver actually at a lower cost. And even though it's not acceptable to the mainstream, as long as those left behind customers will accept your solution, you're well on your way to a disruptive innovation. And that's a wrap for this video on why you should build a disruptive startup. If this was helpful, please click the like button below. And if you haven't subscribed to the channel yet, we've tried to make it easy. Just click on the logo over here and you'll get subscribed. And check out our next video, which should air next week. Thank you very much for watching.